Hello friends, what we are going to learn today is valuation of company. Before learning the chapter, try to concentrate. Whenever we are valuing a company, so this is a company. It will be having assets. It will be having liabilities. And I am writing equity. Equity includes reserves as well as debt. So whether debt is outside liability or not, that is a different thing. It is practically an outside liability, but this is a balance sheet thing. The first question arises is why we are valuing this company. We are valuing this company because this company is being sold and the owners of the company wants to value the company. What is the minimum price they should be getting? Suppose if we are a person who are going to purchase the company, then we are valuing the company. What is the minimum price we should, what is the maximum price we should pay for the company? So whether we are purchaser, whether we are seller, whether we are some analyst who wants to analyze the company, what is the true value of the company, whether there is a merger and acquisition, whether there is joint venture, valuation of company becomes important. Now the question is, if you are valuing a company, you are valuing from the point of view of you always value from the point of view of fixed asset. No, fixed asset is an intangible thing. It is not a person. They are not human beings. So it should be point of view of owners. Now if you go to a strict definition of owners, they are equity. That is equity shareholders plus resource. That is equity shareholders. So you will be valuing the company from the point of view of equity shareholders. In this case, debt will be treated as outside liability. So how you value a company? Very easy concept, assets minus liability. So when you are valuing from the point of view of equity, whether debt will be treated as an outside liability, the answer is yes. So all the assets value, say whatever value is, agreed value or market value is 100. And value of debt is 10 and value of other liability is 20. So what will be the value of the company is 100 minus 20, that is 80, minus 10. Whether 10 will be deducted? Yes, because it is as good as it is outside liability. You are valuing the company from the point of view of equity shareholders. Whenever any discount rate is used, we will be going in next slide that how to value a company's present value of future cash flows. And when we use the discount rate, try to concentrate. When we use the discount rate, the discount rate will be KE, that is cost of equity or required rate of return of equity shareholders. What does equity shareholders expect from the company? This will be when it is from the point of view of equity shareholders. When it is from the point of view of equity plus debt holders. I'll give you an example. I with my friends and relatives own 100% of equity of this company. My wife and her relative owns 100% of debt of this company. I am selling this company, means basically me and my wife is selling this company. If we are selling this company, we will be valuing from the point of view of equity plus debenture holders. We will be telling to purchaser that okay, you will be getting all this assets and only this liability and not this liability, because debt is as good as owner. So we are valuing from the point of view of equity plus debt. It cannot be only debt. Is it right? It should be equity plus debt. Is it right? In that case, debt will be treated as outside liability or not? No, it will not be treated as outside liability. In our case, how the valuation will be done? 100 minus 20. See, it is logical. Now it is coming 80. Before it was coming 70. If you are only equity shareholders, you are valuing from the point of view of equity shareholders, you will be getting 70 rupees. But if you are equity plus debt holders both, you will be getting 80 rupees. Is it alright? Because you are having more money invested in the company. That will not be treated as outside liability. And whenever you use a discount rate, it should be KE. No. It cannot be KE, it should be KO. That is overall cost of capital. That is nothing but weighted average cost of debt and equity. Is correct. Are you getting this? So this is nothing but a value of the company from the point of view of equity shareholders, from the point of view of equity plus debt holders. Now the question comes up, see, when we are doing valuation, cash flow will be an important point. So when you are valuing from the point of view of equity shareholders, you should be taking cash flows which is related to equity shareholders. And whenever you are valuing from the point of view of equity plus debt, the cash flow should be related from the point of view of equity plus debt. So the cash flow which is available to equity and debt holders should be taken as cash flow in this case. The cash flow which is available to equity shareholders should be taken as cash flow in this case. This is valuation of the company from point of view. Let us start valuing the company. Valuation of the company which is based upon TVM, that is the time value of money. Please understand, anything in finance is valued at present value of future cash flow. Whether you want to value this pen, or you want to value aeroplane, or you want to value a company, or you want to value a country, the valuation should be done for the purpose of decision making, for the purpose of financial management. The valuation should be done based upon a concept, present value of future expected cash flows. And it should be cash flows. Is that all right? So now we will be learning some of the formulas for time value of money. Easy formulas for time value of money. If the cash flows are infinite, and you want to find out the present value of that cash flows, how you will find out? Cash flow of first year divided by discount rate or rate of interest. Is it alright? As I told you, if you are valuing from the point of view of equity shareholders, there should be KE. If you are valuing from the point of view of equity plus debt holders, then it should be KO. Is it alright? What should be cash flow relevant? That is important, and let us understand this. See, if you take cash flow per share, what you will be getting is value per share. But when you want to value a company, you are finding out valuation of all the shares. Valuation of all the shares is nothing but value of the company. So you cannot take cash flow per share. You should be taking total cash flow of the company. Here comes the two approaches. Earning approach, dividend approach. That's correct. If it is earnings approach, in cash flow of first year, you should be taking total earnings of the company. Or if you are having a dividend approach, then cash flow of first year should be taken as a total dividend. Sir, why not dividend per share? Because you are valuing all the shares and not only one share. It is very simple. If you take numerator per share, you will be getting answer per share. If you take numerator total, you will be getting answer of total value of the company. Is that right? So either total earnings or total dividend can be taken. if the cash flows are infinite without growth. And now, sir, where this formula came from? It is a simple formula of time value of money. Second, if there is a growth in infinite cash flow, then it is cash flow of first year divided by discount rate minus growth. Again, this formula comes from the basic concepts of time value of money. Again, cash flow will remain same, earning totals, cash flow first year can be total dividend, can be total earnings. The question comes, what should be discount rate? Again, we have understood it if it is from the point of view of equity shareholder. From the point of view of equity shareholders, then discount rate will be is equal to KE. From it is equity plus debt holders. From the point of view of equity plus debt holders, discount rate should be KO. So what should be cash flow? Same. If you are valuing from the point of view of equity shareholders, the cash flow should be relevant to equity shareholders. And your cash flow should be related to equity plus debt holders. Let me tell you, earning after tax, say let me take EBIT. EBIT is not only available to equity shareholders, it is available to debenture holders, government, that is for the purpose of taxation, and it is also available to preference shareholders. Earnings available to equity shareholders, that is EAT minus preference dividend. This is an earnings or cash flow which is available to equity shareholders. So in case of this, you should be finding out cash flow which is relevant to equity shareholders. In case of this, I can take EBIT minus tax. This is nothing but a cash flow which is or earnings which is relevant to equity plus debt holders, which is available to equity or debt holders. That's got it. Again, this formula is a simple formula of time value of money. Let me also, in place of this, cash flow of first year, let me take total earnings. And instead of discount rate, let me take KE. Can I take it? Yes, it is the same formula. That's right. Can I alternative write down this? Earnings into 1 upon KE. It is one and the same? Yes. Now, 1 upon KE is nothing but PE ratio. Reciprocal of cost of equity is nothing but PE ratio. Starting. So, earnings multiplied by PE ratio will be getting market value of company. Starting. You can also find out from this. Sir, where this formula came from? This concept. Where this concept came from? Simple time value of money. Starting. Also, you might have heard this. PE ratio. We have done it in merger and acquisition. It is MPS divided by EPS. If I multiply N in numerator as well as denominator, this is total market value divided by total earnings. Total earnings going on left hand side. It is nothing but total earnings multiplied by PE ratio is total market value of the company. So, see, in any other case, even if some cash flows are available for 3 years, 5 years, 10 years, what is the basic idea is you need to find out present value of that future cash flow. Say if the cash flows are given only for 5 years, then you need to find out present value of that 5 years cash flow to find out value of the company. This is nothing but concept of valuation based upon time value of money. For any decision making process, believe me, this is a true valuation. This is how the valuation of the company should be done. This is based upon time value of money. Let us go to another method, which is earnings capitalization method. Now, as the method suggests, it does not take cash flow into consideration, but it takes earnings into consideration. That's correct. If it takes earnings into consideration, how to value it? Try to concentrate numerator and denominator are remaining same. Instead of numerator being cash flow, now numerator will become earning. So value of the company, in numerator, it will be earnings. That's correct. More appropriately, it should be written as a future maintainable cash flows. No cash flows. It should be earnings. So then what should be written in denominator? KEKO? No. Then it should be earnings capitalization rate. How to find out earnings capitalization rate? This rate is taken from an industry base. How much investment the industries are making, that is in the companies in the same industries are making, and how much profit they are earning. We are right now not talking about cash flows. Is it correct? And from that percentage, you can find out that, okay, industrial capitalization rate is 12%. What does it mean? In industry, same industry, some company, if they invest 100 rupees, they get a return of in the form of earnings of 12 rupees. For every 100 rupees invested, company in this industries are earning 12 rupees. So 12% becomes capitalization rate, and that earnings, it should not be cash flow capitalization rate, earnings capitalization rate should be written in denominator. That's correct. This is earnings capitalization method for finding out value of the company. That's correct. Then we go to other methods. Before going to other methods, let me write down one over here also. See, sometimes they ask that your dividend yield percentage is say 10%. Now what is dividend yield percentage? Dividend yield percentage is the rate of return based upon latest market price. So if I have purchased this particular asset before 1 year, what is the market price will be taken as investment. If I sell it today, how much dividend I have got, how much capital I have gain I have got is my return, but it is based upon current market value. If the dividend yield is based upon current market value, you can still find out value of the company by, in numerator you can write down dividend. See, in numerator you are writing down some cash flows on some earnings or some dividends. Sorry, dividend, and in denominator it will be dividend yield percentage. Sorry, and you can find out value of the company. Believe me, the concept remains same, but it is termed as a dividend yield approach, which is based upon current market price. This was time value of money, earning capitalization method, and then there is another category which is others. Again, I am drawing a balance sheet. There will be assets. There will be outside liability. There will be owner's capital. Now we know if you are valuing from the point of view of equity shareholders, you should be taking debt as outside liability. If you are valuing from the point of view of debt plus equity shareholders, then debt is not outside liability. That is all right. But how will be finding out value of the company is this? Asset minus outside liability. So how will be finding out the value? It is assets minus outside liability. But what should be taken as a value of assets and liability? That is a question. That's correct. If you take book value, if you take all assets at book value, all assets at book value, then this valuation will be termed as a book value method. If you take market value or realizable value, then this is the valuation of the company based upon realization method. And if you take an agreed value, negotiated value, This is termed as net asset method of valuation of the company. Sorry. These are other methods of valuation of the company. Assets minus outside liability, where assets and outside liability are valued based upon different approach, and you get value of the company. Last but not the least method, it is very simple. If number of shares is given and if value per share is already measured or it is already valued, then this is nothing but value of company. This is nothing but concept of valuation of company from different point of view, for different methods by which the valuation is done. So now let us solve some of the questions of valuation of the company which were asked in institute or some RTP questions. First is C5.5. T Limited of 50 crores, there is earnings. Earnings of rupees 50 crores and paid out rupees 40 crores. So what is earnings? Is 50 crores. And what is paid out, that is dividend, is 40 crores. Slightly higher than the average paid in the industry to which it pertains. The PE ratio of this industry is 9. As per the balance sheet of T Limited, the shareholders fund is 2 to 5 crores. Number of shares are 10 crores. In a case company is liquidated, building would fetch 100 crores more and that book value, and the stock would realize 25 crore less than book value. The other data for the industry is as follows. Projected dividend growth rate. So growth rate will be 4%. Risk-free rate of return is RF. Market rate of return is RM. Average dividend yield is dividend yield. Estimated beta of T Limited is 1.2. So beta is 1.2. You are required to calculate valuation of T Limited using PE ratio. I'm doing it one by one. Based upon PE ratio. As we have understood, value of the company or P0 or V0 will be is equal to total earnings multiplied by PE ratio. What are total earnings? Total earnings are 50 crores. Multiplied by PE ratio is 9 and it is 450 crores. Valuation of the company based upon PE ratio. Number 2. Valuation of the company based upon dividend yield. Based upon dividend yield. Start. Now if 40 crores as dividend is taken as a D0, believe me, you need to find out a D1 by growth rate in dividend, that is 4%. Start. So based upon dividend yield, how to find out based upon dividend yield is dividend divided by dividend yield. Start. What is dividend? 40 crores divided by dividend yield they have already given is 6%. Start. What will be the answer is 40 divided by 6%. It is 666.67. Right. Or you can find out value of the company by same formula, but 40 crore is taken as D0, so I need to find out D1 by adding 6%. Sorry. So 40 plus 6%, sorry, it is 4%, right? It is 4%. Growth is 4%. Sorry. 40 plus 4%, it is 41.6 divided by 6%. Sir, which is a good method? There is nothing like good or bad method. Both are good because they have not given whether it is D1 or D0. Normally you should find out by both the methods, or you can find out by any one method and your answer will be correct. The answer is 41.6 divided by 6%. It is 693.33. Start. Third, valuation as per dividend growth model. Valuation as per dividend growth model. Alright, let me do it. Number 3. As per dividend growth model. Which formula I will be using? Value of the company will be is equal to dividend of first year divided by discount rate will be my KE, because I am valuing equity shareholders, minus G. Now dividend of first year I am knowing it is 41.6. If we assume this, it is 40 crore, it is absolutely alright. Now I will be taking D1 as this. You can take as 40 crore, believe me, just assume 40 crore is current dividend. Dividend of first year divided by KE minus G. We are not having KE. We will be finding out KE by CAPM model. RF plus beta into RM minus RF. Whereby RF is 6% plus beta is 1.2. And RM minus RF, RM minus RF is 5%. This will be 12%. Dividend of first year is 41.6 divided by KE is 12 and growth rate is 4%. It is 41.6 divided by 8%. 41.6 divided by 8%. It is 520. Is valuation of the company based upon dividend growth model. Number 4, based upon book value. Start it. For finding out book value of the company, I need my balance sheet, book value of all assets and book value of all liability. Now let us see what information is given. As per the balance sheet of T Limited, shareholders funds is 225 crore. Alright. So this would be my balance sheet of the company. Neither the value of assets is given, neither the value of outside liability is given, but this is given, which is 225 crores. Balance sheet is tallied. Believe me, book value of assets minus book value of liability will be is equal to 225 crores. Assets, whatever might be the figure, minus liability will be 225 crore. Assets on this side minus liability on this side will be is equal to, let me write down, 325. This will be 100. Then only the balance sheet will tally and the net answer will be 225. So, based upon book value, it is directly 225 crores. Fourth method, based upon book value. Directly I can see from here it is 225 crores. Last method, based upon a realizable value, based upon net realizable value. Then I'll have to value this assets and liabilities based upon realizable value. Then this I'm starting with this 2 to 5 crores. Fifth, based upon NRV. What is based upon book value? 2 to 5 crores. I'll be making some adjustment in this. The bidding would fetch 100 crores more, then the value will be increased by 100 crore. Because my assets will increase by 100 crores if I take a net realizable value. Stock would realize 25 crore less. This is 200 plus 100, which is 300 crore rupees valuation of the company based upon NRV. Let's start. So there are 5 different questions that we have answered in this particular. Sorry. A good question to revise day before examination because it covers majority of the method, practically based upon time value of money, also based upon book value as well as NRV. Question number 2, C 5.2. ABC Limited is considering acquisition of DEF Limited. Is considering acquisition of DEF Limited. It's correct. So ABC Limited is purchasing company. And DEF is vendor. Which has 3.10 crore shares issued. So number of shares is 3.10 CR issued and outstanding. The market price per share is 440 rupees per share. Is it right? ABC Limited average cost of capital is 12%. So their discount rate is 12%. The cash inflow of DEF Limited for the next 3 years are as under. You are required to calculate the range of the valuation of ABC Limited to consider. Try to cost it. This is a selling company shareholders. How many shares they are having? 3.10. What is market price per share? 440. So if I multiply N multiplied by NPS, it is nothing but market value of the company. 440 into 3.1. It is 1364 crores. Because this is in crores. Rupees. Try to concentrate. If all the shareholders of selling company sell their shares into market, this is the price they will be getting. So if the shareholders are selling their company to someone else, this is the minimum price shareholders of DEF Limited requires. Otherwise, they will be selling it into market. Why they will be selling it to any other player? They will be selling it to any other player only if they are getting something more or at least this much amount. So this is the minimum price they want for their company. From the point of view of ABC Limited, they will be finding out the present value of future cash flows. And this is the maximum price they are ready to pay for the company. What are the future cash flows given? 460, 600 and 740. I need to find out present value at discount rate. Present value at the rate of 12%. 12% discount factor are given 0.893, 0.797, 0.712. If discount factors are not given, I can find it out on my own. This is nothing but present value of future cash flows, and I'll be finding out this answer. 460 into 0.893 is equal to M plus 600 multiplied by 0.797 is equal to M plus 740 into 0.712 is equal to M plus. MRC is 1415.86. 1415.86. That's correct. Try to concentrate what is this price. We have done this in valuation of security as well as general valuation. This is maximum price ABC Limited is ready to pay for DEF Limited. Now watch this too carefully. This is the maximum price they are ready to pay, so they will not be paying more than this. They will not be accepting less than this. What will happen is the negotiation range will be between 1364, that is the minimum price the selling company wants and the maximum price they are ready to pay 1415.86. This will be, believe me, range of valuation. That is based upon negotiation. The price of the DEF Limited will be between these two figures. It will not be more than this because then ABC Limited will not pay that much. It will not be less than this because then DEF Limited will not accept less than this amount. Let us go to next question. C5.3. Eagle Limited reported a profit of 77 lakhs after 30% tax. So what would be profit before tax if this is after tax is 77 lakhs divided by 30% or 1 minus 3, that is divided by 70%? If you want to find out profit after tax, it is nothing but profit before tax into 1 minus t. So if you want to find out profit before tax, it will be profit after tax divided by 1 minus t. Let's start. This is how I will be getting. So profit before tax in this case will be 77 lakh divided by 70% is 110 lakhs. This will be profit before tax for the financial year 2016-17. An analysis of the accounts reveals that the income included extraordinary items, this will not be repeated, of rupees 8 lakhs and it is income, and an extraordinary loss of rupees 10 lakhs. So if the word extraordinary is written, we will not be assuming that this will be repeated. The existing operation except for the extraordinary items are expected to continue in future. In addition, the results of the launch of the new product are expected to be as follows. Sales, and this is their cost. Alright. So the revenue or the profits from this operation will be 70 minus, this is the 42. Alright. That is the 28. This will be profit from this new product. Alright. You are required to calculate the value of the business given that capitalization rate is 14%. Now try to understand the information of depreciation and non-cash item is not given. So I'm assuming this is earning capitalization rate is 14%. Is it alright? For earning capitalization rate method, how we'll be finding out the answer is nothing but future maintainable profit divided by capitalization rate. Capitalization rate we are knowing it is 14%. I need to find out future maintainable profit, which is very easy. What is profit before tax? Is 110 lakhs after considering all the items except the new business. There is an extraordinary income of 8 lakhs which will now not be repeated. There is an extraordinary loss of rupees 10 lakhs which will now not be repeated. So loss if not repeated, in future my income will be higher. So I'll be adding it. It is 10 lakhs. This is extraordinary income. So if there is extraordinary income in future, my income will be lower. If there is an extraordinary loss in current year, in future, that loss will not recur. So my income will be higher. This is 120 minus 8, that is 112 lakhs. Will be profit before tax of existing business plus of new business 28. This is 140 lakhs. It is profit before tax. Alright. What will be profit after tax? 140 lakhs minus tax rate of 30%. Remaining will be 70%. Stop it. It is 98 lakhs. Will be nothing but a future maintainable profit. And it is profit. What is future maintainable profit is 98 lakhs. Divided by 14%, I'll be getting my answer. Which is 700. What is this? Value of my business based upon earning capitalization method. Future maintainable profit divided by capitalization rate. Calculate MPS assuming Eagle Limited share capital being comprised of 1 lakh 13% preference shares of rupees 100 each and 50 lakhs equity shares of rupees 10 each, P ratio being 10 times. Now, what is earnings available to equity shareholders is 98 lakhs? No. 98 lakhs is a profit after tax. From profit after tax, what is paid is preference dividend. What will be preference dividend? 1 lakh into 100 multiplied by 13%, which will be 13 lakhs. This is earnings available to equity shareholders, which is 85 lakhs. So, earning per share will be 85 lakhs divided by 50 lakhs. 50 lakhs are number of shares. 85 divided by 50 lakhs is 1.7. Stop. This is EPS, earning per share. I want MPS, which is nothing but EPS multiplied by PE ratio. EPS is 1.7 multiplied by PE ratio is given, which is 10. So MPS will be 17 rupees. Alright. A simple question, which is C5.3 based upon earning capitalization method. Let's start with next question, which is C5.4. Given below is the balance sheet of S Limited as on 31st March 2008. Share capital is given, reserves and surplus is given, creditors is given, land and building is given, plant and machinery is given, investment is given, stock is given, debtors is given, and cash in bank is given. You are required to work out the value of the company, the share, on the basis of net asset method and profit earning capacity, that is capitalization method, that is earnings capitalization method, and arrive at a fair price of the share, that is one share, by considering the following information. So what we'll be finding out, try to concentrate. We will be finding out the value per share based upon net asset method, based upon earnings capitalization method. Once I get the value and arrive at a fair price. So what is fair price? By net asset method or earning capitalization method? If nothing is given, we'll be taking average of both. Average will be nothing but fair price of share. So we are practically doing valuation of the company by two methods. Profit of the current year is 64 lakhs. If nothing is given, I can assume it is profit before tax. Sir, if nothing is given, can we assume it is profit after tax? The answer is yes. Is it alright? I am assuming it is profit before tax. Includes a 4 lakh rupees extraordinary and 1 lakh income from investment of surplus funds. Such surplus funds are unlikely to recur. Is it alright? So let me do it both simultaneously. Earning capitalization method net asset. Earning capitalization method, I'll have to find out future maintainable profit. Profit before taxes 64 lakhs, out of which 4 lakhs extraordinary income and 1 lakh income from investment are not going to be repeated, minus 4 plus 1 lakh non-recurring income, that is 5 lakhs. This will become 59 lakhs. Again, it is profit before tax only. In subsequent years, additional advertisement expenses of 5 lakhs are expected to incur each year. So additional expenses, this income is not going to recur, so I have subtracted it. this expenditure are going to incur. They were not included in this figure, but now they are going to be incurred. So I am deducting it again. Rupees 5 lakhs. Market value of land and building and plant and machinery have been ascertained at 96 lakhs and 100 lakhs. So land and building will be 96 lakhs and plant and machinery will be 100 lakhs as per new value. This will entail additional depreciation of rupees 6 lakhs each year. So minus additional depreciation 6 lakhs. The 11th, so there is 48 lakhs. Will be profit before tax. Start it. I'll be deducting tax from it. There is no other information? No. Effective income tax rate is 30%. Capitalization rate applicable is 15%. Minus taxation 30%. This is the profit after tax. Profit after tax will be 48 lakhs into 70%. That is 33.6 lakhs. Is nothing but future maintainable profit. Sorry. Value of the company. Future maintainable profit divided by capitalization rate, which is 33.6 lakhs. Divided by capitalization rate given is 15%. Will be 33.6 divided by 15%. It is 224 lakhs rupees. Is the total value of the business as per earning capitalization method. How many number of shares are there? 10 lakhs. Those all rupees are in lakhs. 10 rupees a share. So there are 10 lakh shares. So value per share will be 224 lakhs divided by 10 lakhs. Lakhs will get cancelled. This is 22.4 rupees per share based upon earning capitalization method. Let me go by net asset method. Now net asset method is very simple. Total value of assets minus outside liability. What is total value of asset? Total value of asset is agreed value when it is net asset value, realizable value when it is based upon realizable value, and book value when it is based upon book value. So I know the total. I don't think I should be repeating all the assets. I can just adjust this and I'll be getting the answer. I can just make a total once again. It is 96 plus 100. All assets is 96 lakhs plus 100 lakhs plus 10, 20, 15 and 5. This is agreed value. 96 plus 100 plus 10 plus 20 plus this is also 20. It is 246. It is value of the all assets. Yes. Minus outside liabilities will be creditors. Yes. So outside liabilities are creditors, which is 30. What will be value of the business is the 216 lakhs. Sorry, 216 lakhs divided by 10 lakhs. This is value of total value of the business. So value per share will be 216 lakhs divided by 10 lakhs. Lakhs will get cancelled. This is 21.6 rupees per share. How to find out value of the business or fair value of the business is average of both. Earning capitalization method, it is 22.4 rupees per share, and net asset method, it is 21.6 rupees per share. And they have told us to find out fair price. Fair price will be average of both. 22.4 plus 21.6 divided by 2 is 22 rupees per share will be nothing but fair price of the share. Now let me tell you one thing which is given in the suggested but I have not done. They have deducted from this 224 lakhs this 30 lakhs which I have not done. And believe me, as per my opinion, deducting this 30 lakhs rupees is incorrect. When this 33.6 lakhs rupees is generated by this company. Now company does not include only assets. It includes a net assets. So net assets of the company, which is 224 lakhs, has generated this income of 33.6 lakhs. When you say net asset has generated, this 224 lakhs rupees already considers that creditors. Anything which is generated by the business is not generated by gross asset. It is generated by net asset. So as per my opinion, deducting 30 lakhs rupees is an incorrect answer, not even an incorrect assumption. I have done, as per my view, this is the correct answer which you should follow. We'll be going to next question. C 5.5. Using the chop shop approach or breakup value approach, this will be learning. It is easy. Assign a value of the Canberra Limited whose stock is currently trading at a total market price of £4 million. For Canberra Limited, the accounting data set forth the three business segments: consumer, wholesale and retail. Consumer, wholesale, retail and general centers. Data for the firm's three segments are as follows. So there are three segments: wholesale, retail and general. And try to understand this chop shop approach or breakup value approach is, first we will be considering sales figure. Based upon that sales figure, in some manner we'll be finding out value of the business. Then we'll be considering asset figure. And based upon this figure, we'll be finding out value of the asset. Then we'll be understanding segment operating income, and based upon the income, we will be finding out value of the asset. That's correct. Now, I feel that in this question, this information should be given in a correct manner or in this manner. It is given sales by capitalization is 0.85. What should be given is capitalization by sales is 0.85. Is it alright? Well, how they have drafted this, I don't know, but it should be actually capitalization by sales, capitalization by assets, and capitalization by income. Is it alright? I cannot say whether it is correct or incorrect, but not to confuse the student, they should have given this information. Industry data for the pure play firm has been compiled and summarized as follows. Now it is very simple. Try to understand it is just multiplication and then addition. What are segment sales of this business? Wholesale, retail and general. What are segment sales is 225. Everything is in pound. 7,20,000 and 25 lakhs. What is capitalization sales ratio? 0.85, 1.2 and 0.8. Based upon sales, this is the value of the business. What is the total answer is nothing but value of the business. 225 multiplied by 0.85 is equal to M plus. 72,000 multiplied by 1.2 is equal to M plus. 25 lakhs multiplied by 0.8 is equal to M plus. MRC is 22 lakh 77,650. $22 77 I think answer is incorrect. 2,25,000 multiplied by 0.85 is equal to M plus. 72,000 the 7,20,000. multiplied by 1.2 is equal to M plus. 25 lakhs multiplied by 0.8 is equal to M plus. MRC is 30 lakh 55,250. Yes, 30 lakh 55,250. This is 7 lakh 20,000. So now what I have done, try to understand. This is our sales figure. This is which figure? Capitalization by sales figure. If we multiply this two, we have multiplied this two. Sales will be getting cancelled. We will be getting answer of capitalized value or capitalization or value of the company. In similar manner, we'll be doing this. Based upon asset, 6 lakh, 5 lakh and 40 lakhs. It is 0.7, 0.7, 0.7. This is 4 lakh 20,000. This is 3 lakh 50,000. This is 28 lakhs. So 28 plus 3.5 plus 4.2 is equal to 35.7. Alright. This is value of the business. If I find out value of the business by my assets and asset capitalization ratio, sorry, I'm getting why I'm multiplying this two again. This is assets. What is this? Capitalization divided by assets. If I multiply this two, I get capitalized rate of segment of the business and this total capitalization. Similarly, same income is 75,000. 1 lakh 50,000 and 7 lakh, and capitalization is 9, 8 and if I find out this total answer, this will come 46 lakh 75,000. Again, what is this? Income. What is this? Is capitalization divided by income. If I multiply this two, I'll be getting answer of capitalized value, which is nothing but 46 lakh 75,000. So those are three methods by which I can find out answer of the value. Also, you can do one thing is find out average of this three and say that this is a value based upon chop shop approach or breakup value approach. This is 30 lakh 55 250 plus 35 lakh 70,000 plus 46 lakh 75,000 divided by 3. It is 37 lakh 66,750. It is average value based upon all three methods. I feel that this should be capitalization by sales instead of sales by capitalization. But if the same question is asked with sales by capitalization, you should understand as if it is capitalization by sales method. It was asked 2 times, November 2011, May 2018, and both the time what was written was the sales by capitalization instead of capitalization by sales. This was C 5.5.